Hey everybody, happy Monday afternoon. Just a reminder, everyone, of the disclaimer. So that anything we talk about today is for educational, entertainment, and information purposes only. So, of course, as we've been talking about, there is still a lot of risk. I've been talking about the two kinds of light in the distance that people have been seeing, hoping that it's light at the end of the tunnel. And I said that, yes, technically it could be. And in fact, I thought we could maybe rally a little bit more to around 58.40. But ultimately, I said the light at the end of the tunnel is probably a freight train coming towards us in terms of the fundamental backdrop. And sure enough, fundamentals are outweighing any notion that we're oversold right now. So we can see the S&P basically continuing down from those all-time highs, has basically broken this support line, retested it a couple times, and then the bottom fell out again. So I wouldn't be surprised if we got a little bit lower and then started to maybe have a couple day bounce towards that 9 EMA and the 200-day moving average, which we have now violated quite strongly. We've broken Friday's lows, which is not a very good sign. On the other hand, I can see some of the RSI, I don't have it on here, some of the RSI signals are showing that we're as oversold as we were on August 5th. Remember when we dropped down to about 5,100 and the S&P was very, very ugly. So we're starting to get a little bit oversold, but look, there is a ton of stock for sale here. I mean, it's a deluge of stock, right? If you are buying this market, you are pushing a massive boulder up a hill. Every rally is met with CTA selling, vol targeting selling. At the end of the day is all this sort of synthetic gamma from levered ETF selling. Just think of the backdrop. I mean, we've gone from one of the more, this notion that we have one of the most pro-business, pro-market administrations of all time to an administration that is literally wanting the market to go down. It wants things to break. It wants the 10-year to drop below 4%. It wants to get down those debt servicing costs. This is an absolute 180 if I've ever seen one. And it's going to be very, very difficult for the market to climb this large wall of worry. Can we get rallies? Of course. I mean, it's the market. It's going to have up and down days. Bear markets can have very, very big rallies, in fact, and they can throw you right off and make you think that everything's fine again. But right now, it's just hard to build a thesis for this backdrop to be improving in any substantial way at this point. I can't see my way around having that kind of conviction that we are just going to shrug off everything that's suddenly happening around the world, all this money that's fleeing the country, the American exceptionalism for years and years and years and years, really starting to unwind. Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video. It's just a very difficult situation for stocks right now in a world where a ton of people own stocks, more households than ever own stocks, and they were all in January. Massive buying, 28 days in a row of retail buying, just everyone all in. So it can take a little bit of an unwind to get some of this. A market that was basically priced to perfection is having to unwind and really face a new reality. So you look at this chart here, the S&P daily, we've broken down below that 200-day. I mean, I don't know how far we can go to this point. We're going to have a bounce in here somewhere. Let's take a look at S&P, or here's the QQQ weekly, starting to break below that support line. That is very, very concerning. This is the beginning of, after the 22 bear market, we had this big AI move, and here we were just winding up higher highs, higher lows, and now we're starting to break below this trend line. We need to recapture some of these levels in a hurry, or this is going to be lasting damage. Here's your IWM. So, of course, it doesn't like recession. IWM likes lower rates, but it doesn't love lower rates for the sake of having to support a cratering economy. So it's having a little bit of trouble here. We're seeing a little bit of support in the RSP, which is that equal weight index, S&P index. So some signs of maybe just a little bit of support. The money's got to go somewhere, right? It's got to go somewhere. Maybe it gets into fixed income a little bit, although I think that has its problems as well. So we look at here, Doge and tariff, short-term pain for long-term gain. This is from Apollo. So this is your economy today. How big is this transition period here to get to these positives from Trump, which is a smaller government, bigger manufacturing sector, lower imports, we're going to get tax cuts. how difficult is this period? This is what the market is trying to figure out, and it's certainly a shoot first, ask questions later. Right now, the narrative has changed 180, so that there's just no one's going to do anything except sell at this point. Maybe in the end we have some positives here, but this sort of Mar-a-Lago Accord that Trump has really been kind of pushing, which is this idea that the U.S. gives the rest of the world security, access to U.S. markets. It wants a weaker dollar, right? It wants a weaker dollar. It wants the bigger manufacturing sector. It wants the 1950s and 60s and 70s all over again. It wants to reinvigorate the lower class, which will spill over into the middle class, et cetera. Although I wonder how much of that is possible with robotics. And I saw some company today come out and say, we're using one of the robot companies, and it's this humanoid robot that's starting to do all these tasks in the warehouse. I mean, how is that good? They're saying, oh, it's going to improve efficiency for existing workers. Yeah, sure. It's going to cost existing workers jobs is really the truth behind that. A lot of BS behind the scenes. And I think this AI situation is very, very threatening in many ways. Back to this, so existing treasury debt swapped with new treasury century bonds, so a little bit of financial engineering in there as well. But the problem is the tariffs, you need those tariffs to accomplish something that he's talking about here, this reinvigorated manufacturing class to pay for that. But the problem with this plan, and I don't know, maybe some parts of it are going to work, but the problem is you want to move all these things, auto manufacturing from Canada and Mexico, you want to bring everything back home. That's going to take a long time. So how long, again, is this trough of disillusionment, of pain, this almost like in options, you call it this sort of valley of death. We're in this valley of death right now. How long is that going to be? How much short pain are we looking at? And another thing is globalization. I mean, this is really kind of an intent to unwind globalization. And what does that mean? Well, they want that is going to undo some of the pressure. The inflation has basically been compressed due to globalization, the ability to go and look for things around the world, find the cheapest source for labor, for goods, et cetera, for manufacturing. That's low inflation. So a more siloed economy where companies are reshoring and doing things on their own, that's gonna put pressure on inflation, right? You can't make things very cheaply in the US where wages are very high compared to many places in the world. Yes, China wages have gone up over the last 10 or 15 years, but the inability to kind of look around for money to flow to where efficiencies lie is going to be difficult. I'm not saying that's a bad thing to unwind some of that globalization. I think that's actually probably not a bad thing. I think there's a lot of negatives to globalization. But let's be honest. This is probably going to involve higher prices, some inflation. Maybe we start to get some deflation from demand erosion, from AI, from those kinds of things. Let's hope that's true. Maybe that's part of the idea, right? Elon and company are kind of chirping into his ear. Don't worry, we're going to take care of some of these inflationary problems. So onward, and then also with these tariffs being implemented, and everyone being siloed, that just creates less of a reliance on U.S. markets, right? Countries are starting to do their own. Look at what's happening in Germany. Their own defense spending. They're spending a ton of money there. They've done a 180, and the U.S. and the German market is at all-time highs. They are going bananas on military spending. Well, that kind of undoes some of the first part, which is the U.S. is the security for the world. Well, it doesn't have to be the security for the world as much anymore. So very, very interesting things afoot here. And sure enough, here we go. Fewer people planning vacations. We showed you some of these charts before, expecting fewer jobs. There's a definite massive erosion of confidence out there on the business side. Think about it. Where are analysts even going to place their bets in terms of where earnings are going to be, in terms of where those outlooks are going to be? What can CEOs really say at this point with everything completely up in the world and changing from day to day? We've got tariffs. We don't. We're going to ease these ones, or we're going to add more. Like, it's just all over the place. And I'm not criticizing the method, but from the market's perspective, it's madness, right? Hopefully there's a method to the madness, but right now it's a little bit of madness. CapEx getting crushed. Look at the jobs from Doge. Look at the jobs created in the government over the last few years. This is in the green in these bars here, 2023, 2024. Well, if you're starting to bring in efficiency to the government, that's a lot of jobs. That's going to impact the economy and employment, of course. And look at something like this: the government, Department of Government Efficiency, DOGE, looking at this. They discovered 35,800 ServiceNow licenses on 3 products that ServiceNow has, only using 84. They only have 84 of those licenses being used by ServiceNow. How is that bad for ServiceNow? Yeah, you can bet that's bad. So this digital world is this is why I'm kind of pivoting a little bit to other areas that make sense. Touch and feel things, real things. Look at McDonald's doing well today. We may have a backlash against the digital world, against AI to some extent. We're seeing that expressed in markets right now. Maybe there's this sort of uncertainty. I don't even know how does AI even play into some of these SAS companies, right? I have a very, very smart mentoring student in technology, says some of these companies may not even be able to survive. AI is completely going to destroy their core business. So there's a lot going on in that area, which is negative for technology. So that's why I'm saying look around. There's some other things. I did a video the other day on how I look at quality companies now. I'm going to post that in the description below, how I am finding quality companies that fit this new market outlook. So here we are. 75% chance of recession within the next 3 months. Peter Berezin. Now he came into the year bearish. He totally kind of nailed it, except for the first couple months of the rally. But he nailed this. And so there's this idea that look, some of the estimates out there are around 30%. He's at 75%. He's saying, look, this is a new situation where they are under. Stating the risks here. So they're not quite understanding how deep this can get because the balance of those risks have shifted, right? It's a matter of time until the forecasters start to revise down those growth projections, which then suddenly start to affect some of the expectations for recession. So we're just at the beginning of a constant news flow of negative headlines, and as the lemmings get on board and start jumping onto, hey, things are slowing, things are looking poorly, we're going to see those recession odds go up, and then of course those can be self-fulfilling things, right? The more you talk about it, the more people hold back and don't spend, and it creates a little bit of paralysis out there. So there are going to be some significant revisions downwards in GDP, in outlooks for many, many companies. And so really the odds of recession, in my view, are greater than 25 or 30%. They're there, and you're going to see people talking about it. So hopefully that gives you a little bit of an idea. I know it's a little bit of a downer, but be safe out there. Watch my video on how to find really, really good companies, quality companies, cash flow, real touch and feel businesses. Now, I like other things like Netflix and but things like Costco, people are going to go into Costco. They're going to get into the TJXs. They're going to dollar stores. I kind of like in theory, but they're just such crap. I just don't know if I can fully jump onto that. But you know what? For a trade, I might get into something like a DG, which has been acting very, very well, Dollar General. Some interesting things out there, but start to think of what does well in this kind of situation. That's not to say that MAG can't come back and have a big bounce, because those are the balance sheet heroes that tend to do well when everyone's kind of, panicking and looking for solid companies. So I don't think their prospects are bad. It's something like a Meta I really, really like. Something like an Amazon I think is pretty good. So there are some interesting pockets there that I think could be worth getting into, even after this, especially after this big sell-off. But for the most part, I'm starting to look at different kinds of things, and I think that's where you can potentially ride out a couple years of difficulties as we start to get to our where's our little chart here? No, that's not it. This here, through this trough of disillusionment, the valley of death, as I call it. So hopefully that helps you guys a little bit. Check out the link below for the other video, and we'll see you next time.